Hello, ladies and gentlemen, and welcome back to the daily recap for markets around the world. As always, we're going to be covering off stocks, commodities, and cryptos today and deep diving into the macro and other data, but we've got a lot to discuss. First up, the market ended up creating the head and shoulders, broke through the level on the Nasdaq, and moved down to pretty much completion. Then came Google and of course Microsoft results. The market liked what it saw, even though it wasn't setting a very high bar. And realistically, we pushed right back up to one of the most important levels over the next 24 hours. So we'll be breaking down this level and also talking about what the Federal Reserve is going to do next, because most people expect a pretty massive rate hike here in the statement. Will we get it? And will we get 100 basis points? Stay tuned. There's so much to talk about. See you soon. Well, welcome back everyone to the Daily Show where we talk about stocks, commodities, and cryptos. If you like any of those markets, consider subscribing and of course give us a thumbs up if you find value in today's video. Let's begin by talking about Google and Microsoft earnings before we get into the macro indices and other things. We'll start with Google and Microsoft. I mean, there's no doubt that the bar has been lowered by big tech. Basically, we don't expect much. The market doesn't really expect much. Both companies reported some worrisome results, but the stocks rose anyway, as of course Wall Street was afraid of much more. Look, the results here for Q2, yes, they show some degradation, but it's actually Q3 or Q4 where we'll see the true underpinning of what the Fed's interest rate hikes are going to do to businesses. Remember, this is the big problem. Right now, you could actually still see a bit of a bullish movement, yet still the economy is quite sick, and it comes through where Q3 and Q4 are actually the worst results. So the market didn't have much expectation and they got exactly what they wanted, if not a little bit better. And this has meant that the markets rallied after that period of time. Now, what is retail thinking right now? Well, we polled our community and 60% of you were still very bearish. About a week or two ago, 70% of you were very bearish. And it's partly why the last month we've been so bullish on the market. Everyone's just so damn bearish. Everybody's putting puts all over the market, and they're probably correct, but it's all about timing and all about understanding which area you want to be in. The past week has been one of the heaviest sells from retail since September 2020. We know that didn't work out well because while the market did sell off in September of 2020, it rebounded massively into October, November, December, and started another big rally. So we've got to be careful of what the general herd of retail traders are doing. Unfortunately, some of us out there are making the wrong mistake, and it's why a lot of us lose. So at this stage, we want to follow the price action, and we'll be talking about that very, very soon. But of course, retail are going against really the current trend on the small timeframes. Let's talk about smart money confidence. Well, we've seen a lot of smart money come in. These guys have totally different timeframes to what a trader or even a midterm investor would do though. They're buying to hold for years. So we've seen this trigger a few times over the years, and in general, I guess it has a slightly good track record at picking bottoms. Certainly not in 2008 though. That was a bad time and they picked it. They thought it was good. That dip was good. It turned out not to be. Will they be correct this time? Well, at the moment, it seems like a little bit of smart money is purchasing in. Now, there are some reasons why they're purchasing. One of them is, of course, here the World Container Index. We're seeing it drop steadily through this 2022 point. Basically, this means shipping costs are coming down, which is, of course, a big tick against inflation. It means that one of the supply chain problems is starting to fix itself. There are caveats to this. If China locked down straight away again, that could go straight back up. Obviously, the Fed's doing its job to a degree here with reducing demand, but are they doing it fast enough without damaging the economy? These are the questions. They're the million-dollar questions that we ask ourselves all the time. In terms of the expectations of the Fed, most people or most economists think that we're going to raise the rates around 75 basis points, with some economists going as big as 100 basis points. So you can see here 75% are on the 75 and 25-ish% are on the 100 basis point increase. I think the market expects 75. The market could still go up even with that kind of number. Remember, it's not so much our opinions that matter. The market's going to do what the market's going to do, and we have to follow the price action and react to its movement, react to what the algorithms are doing, and try to have the patience to not try to make too many predictions on these big numbers. Buyback leaders, this is why some of the stocks have held up quite well this year, because Apple's been one of the best stocks in the market. There's no doubt that if you had just an Apple portfolio at certain times, you'd feel pretty good about the market this year. It's nowhere near as brutal as some of the other stocks. $23 billion in buybacks Q1 here from Apple. And this is kind of the story of the US market. For the last decade, buybacks have been a huge part of many stocks' successes and actually holding up. Even though they weren't growing that much, they just had so much available cash thanks to the Fed. So expect this to continue through the next couple of years, and buybacks to be a good symbol of kind of holding a strong stock price. And of course, that's something that many investors look for as well. In terms of investing, what do you want to do out of a recession? Well, of course, you can make your own decisions on this, but generally recessions or pullbacks, the first stocks to go up are the ones that got beaten the most, and they tend to be small caps and growth. So that's why the Nasdaq often leads a recovery, and also why small caps such as even RK, which have been absolutely destroyed through this pullback so far, are the ones that will usually base first. So it's worthwhile having those on your charts, looking at them. We'll of course be following them here on the channel and looking for the signs of real recoveries. But yeah, that's what happens. And you can see here the outperformance of the small caps versus the mids versus the larges. Another thing about 1 year forward percentage, if we take the current start of 2022, where we've had a 15% decline, what has happened usually after that point? Well, you'll notice here that the average return 1 year later is 18.6%, with the kind of minimum or the worst kind of return being 21.7. That's like a coin flip in terms of up down just from the average, not the max, just the average. So what that's telling a lot of investors is maybe it's time for them to jump in and at least buy some portions. That's why you're seeing Smart Money Index and other players coming in. They've got longer term prospects. They could be wrong, of course, but they've got the money to be able to put in slithers and effectively use things like dollar cost averaging, which is a technique that many people do use in quality assets. And that's why it's become the odds maybe are in their favor to make these positional changes. And it's a very cool stat and certainly worthwhile thinking about. Now, why are so many retail traders bearish? Well, part of it is to do with everything looks bad. They're probably correct. And we are as well. But the other thing is that you've got midterm elections still. Remember, volatility tends to spike the most in October and September for midterms. September is the worst month of the year for the S&P 500. It's the one that always goes bad, it seems. And October is also a bad month. So both of these tend to have the biggest amount of volatility spikes, and that's still coming. 2022 has been the year of inflation and all other problems, but it should have been the year of volatility due to midterm elections as well. So expect that still to be a story on the horizon. Another thing that's worthwhile paying attention to is, of course, implied volatility moves. If you're going to play the options game or you're going to play trades around earnings, you need to know the implied volatility. We saw Microsoft kind of close or after hours go up about 5%. Of course, that's in line with what the options expected, 5 to 6%. Apple's expected to go about 5%. Well, possibly the options market will be correct. And look at this one, Shopify coming out soon. Ooh, that's a big one, 13% implied volatility. So if you're not aware of the kind of big risks that can be put on these stocks and you have a stop loss and it gaps you and then you lose your account, well, you really need to start paying attention to things like this. And of course, we'll share those throughout the earnings season moving forward. And if you guys like it, let me know in the comments down below. Implied volatility of stocks, and then we can actually set support and resistance levels based on that as well. Earnings season beat rate 70% so far. That's actually a tick. That's pretty good. That's really good. Earnings beat rates, hey, 70% is actually on par with what we usually see at this time of year. 289 beats, 124 misses. Yes, expectations are low, but in some ways, so is the market. The market is also low at this stage, and that's why we could be seeing further bull runs here in this market. Shopify coming out before the open on Wednesday. Then we have Meta. That'll be an interesting one to see how bad that company's doing. And of course, we've got Spotify, Teladoc, some big kind of hyper growth stocks. And then the big ones come Thursday, Apple and Amazon. Watch for our special tomorrow on both of those stocks. Make sure you subscribe so you get more content, because that will be a very, very important level and a very important day for these markets. What happened during the session? Well, it was kind of like the doldrums. Everything went down, and then they slightly bounced into the end of the day. And then, of course, we had the after hours market where everything looked a lot better. So the futures are now up quite nicely after this. Which sectors were doing well? Well, it was gold doing quite well. That's nice. And we also had utilities, healthcare coming back through, and staples coming back through. These are defensive sectors. So if we continue to see this trend, remember we've had really 2 of the last 3 days, some of the best sectors have been defensive sectors. We've got to be very careful of the bull trap. The more the market moves into the defensive sectors, the worse it's going to be for us, because that means they're really stacking into the defense, potentially getting ready for the sell-off. And we'll, of course, hopefully be there together with you guys when that occurs. Let's move over to the VIX, the Volatility Index, and we'll get into the charts here. The Volatility Index, 24.68. Didn't really bounce too much, even though the market fell down. I'd probably expect the volatility to potentially drop here. It is earnings week. Generally speaking, once we've broken underneath 24, we've moved down to 20, and that's kind of coincided with a relatively bullish market at this stage. DXY, now this is where things get interesting. Look here at the trend line we drew yesterday. If you took bullish moves off this, you would have been pretty happy in the last 24 hours. But let's go and dive into the smaller timeframes. Let's understand what's happening here on the smaller timeframes. Well, we know there are most likely orders stacked behind here. There's a lot of, let's call it distribution. We've gone back up to this resistance, and at the moment, it looks like we're starting to change trend towards the downside. Take a look at this. So we haven't quite made, we barely made new high here. We've obviously got some nice kind of demand here. And if that breaches through, you could really see the dollar index weaken. Of course, if the dollar index weakens, what happens? Then we see usually the stocks go up. Most of this will coincide with the Fed FOMC statement and funds rate. Don't expect a huge amount of volatility until that has gone through. And then at that point, we should be able to see clear direction. So if we get a new low here on the DXY, it's going to be very good for, of course, things like the stock market. If we end up breaching through this level here, well, we'll have to completely reassess what we're looking at, and maybe the markets will actually start turning down, because that will mean there's a huge bullish strength here in the US dollar, possibly weakness in the stock market. So there's a lot going on, and a very important level indeed. Small traders will be looking at this and looking for the breach, and then specifically focusing in on the trend line, or focusing in on the 10750. Once they see those loans, they'll probably be able to make pretty decent decisions. Let's have a look at the euro just to coincide with that. If anyone doesn't know, the dollar index is made up of a huge weight to the euro US dollar. We saw it come down to what we call a defended zone, basically a whole bunch of nice supports. It found this level. You'll notice I've got a resistance here at 10152. I'm looking for that to break out. And if that breaks out, then pullback should be met by bull demand. It looks like it's on a nice demand zone, but of course, with the FOMC coming, some traders will just like to stick out of this market until it's much more replicable and easier to spot. This is the type of high adrenaline trading if you take trades into things like the FOMC. But if you like that, hey, I'm not stopping you. Copper over here moved up, and then it sold off a little bit. Again, another one waiting for probably this FOMC, which is kind of the story of today's market. You'll notice there is a bit of a trend line behind the back here in copper. Hopefully it can continue to hold up. If it does spike through, breach through maybe a 3.4, that could be another sign of a small rally here coming in the markets. I'd like to see a new low formed, then it breaches 3.4, and then hopefully bulls up to 3.55, which is another really nice zone that was formed previously on its way down. It's time for copper to really have a bit of a recovery. And as we saw, iron ore and copper are at incredibly important points in this market. Move over to gold. Gold is holding its best. Again, another defended zone. You'll notice here, big level, obviously series of lower highs. Doesn't look too strong for gold at this stage. Not prepared to really make too many decisions on gold yet. I don't mind if it comes down to 1700. I would like to see it bounce off there though and start to move forward. Could be good trades after the FOMC. I do think this one will be volatile. So be careful, guys. Gold's going to be volatile through the next 24 hours as well. Another one to most likely just, focus on very, very soon. And then we move over to yield. So yields continue to be kind of high. We saw the, let's call it okay announcement from Microsoft and Google, and the yield slightly spiked. It's just, I guess it seems like any kind of good announcement coming out of stocks seems to spike the yield, and any bad one brings it down. And that's expectations of where they expect the rates to be in the future. The US 10-year bounced off the demand again. Going through this zone will really show an incredible sickness in the economy. So at this point, just something to watch. Probably not place too many trades off it just yet. Oil, what's going on there? Well, oil hit our downward trend line again, and it seems to be just really struggling here. You would have thought there would be some buyers that might have come back in around here. They didn't. There's no strength of structure, and that's why you have the patience to react, don't predict. You might think, oh, I want to buy. Let's say it comes down here. I might want to buy, try to get it through that trend line. That didn't happen. It didn't get through the trend line. It didn't activate the buyers. Unfortunately, that means that maybe oil is going to continue to weaken. Now, some people will be celebrating that because it means cheaper petrol, cheaper gas in the US. That'd be cool. Obviously, a lot of people need that right now. And you'll notice here the daily has a shooting star on it. Look, I don't think this looks very strong. If the FOMC pushes it above that wick, then okay, yes, buyers are back in. At that point, I'd be saying, okay, I think buyers are here. We need to look for buys. We've changed our trend. Things are looking much better. At this stage coming in, I could only see weakness at this point. The market just doesn't show any strength. Would I sell it? Probably not. But if you were looking towards the short, this is the best time you've had. Every single time it's come down here, it's looked okay. At this point, it looks incredibly weak on oil. Let's move over to Tesla. Tesla came down pretty much to a pretty good level. Obviously, anywhere in this gap fill is what you're looking for at this stage if you're a Tesla bull. Move down, ideally find some buyers, and then move up. Tesla, really resistances becoming support, the pretty traditional role reversal area. And if the markets do continue to hold up through the FOMC and through the rest of the earnings, could be a nice level or zone here if you're a Tesla kind of holder. Let's move to Google, and Google was up after hours. It fell 2.56% through the day, and it came back down to a very pivotal kind of level here. It'll bounce in the next 24 hours, as in we'll see that buyers come back in. If they do maintain the buyers, then maybe it's worthwhile considering potential positions in the long side for at least the short term. But do remember, this could all be part of one giant distribution. If we get a new low underneath here, it's probably a good sign that the rest of the market is about to tank as well. So be very, very careful here on Google. I think we'll bring this chart back on quite a few times over the next couple of weeks. Check it out on the weekly here. That is great accumulation potential or distribution. And you've got to be very careful. If you are buying down here, well, of course, you've got tight stop losses in a plan, decent volume coming through, certainly an okay level for Google for the long term, but there may be even cheaper levels to come, especially if it makes a new low. That would be diabolical for a stock like that. We'll move over to the DAX and begin our indices. Same thing as we said previously. I would love to see it breach 13,450. If it does and close above, I do think we not only fill the gap, but we potentially start a really nice rally here across all markets. I'm watching the DAX incredibly closely. I want to see this breach above close. Then we have a base. We have, of course, the double bottom going into here, which we've already talked about. And then we squeeze all of those shorters that are here. That would be nice. I would like that quite a lot. The squeeze. That's what we want to be doing. Let's move over to the Nasdaq. Was a decent little day trade here. If you got it, you would have had to be incredibly patient, wait for that head and shoulders to come down, the breach, the movement back up. I prefer the S&P 500 on this, so I'll show you later. But basically, this was a little bit of a turn, and now we're moving up to a lot of orders. You'll notice I already had this kind of green box here. Probably want to move it to around this level. There are orders all the way through this 12,300 zone. So expect this to be a big fight for the FOMC day. We may break it through, possibly then pull back even drastically down to like something like a 12,150 and then still see the buyers. It was a strong rally. It shows that there are buyers here. If the buyers continue to come through for the FOMC, then yeah, I mean, you could really see some nice rallies going on here. Think about just even the trend lines on some of the markets. Some of the trend lines have been broken in some ways here between the lows. I do think 12.3 to 12.350 holds the key. We want to see a breach above that. And that brings us to, of course, the S&P 500. Notice very similar 39.60 here, where we've had a lot of orders placed through. This is a lot of kind of orders sitting, all sorts of things. The change happened exactly where we talked about it. 39.20 was our previous sup. We saw the market come down, react with this zone, make a slight lower low to induce. Remember, it induces the shorts. Then it came up. There were some nice trades in here if you did get it for the session. And now we're back to that previous trend line, which we fell through. Breached 39.60. Pullbacks after that point, you would think, would be met by bull demand. And then we want to get through that 39.75 zone. Once that happens, should make a new high at that point. So much, much better. If you're feeling bearish in the next 24 hours, really you just have to get it back under here. If it breaks this level again, we get a new low. Each pullback should be met by sell demand. And that's why this was such a critical level that we brought up in the previous video. S&P 500 is the same, still targeting really this idea of the 20 moving average, the mean reversion. Of course, that's where we expect markets to go to. Why? Well, they generally do. R1 is sitting here as well for the monthly, so that's about that 4100 zone. I'd like to see the market get back up to here through earnings. And so far, so good. But of course, it's choppy on its way up. Why are we kind of positive here? Well, look at this. This is the bearish options that were placed in the last 24 hours. Lots of bears coming in and chucking puts all over the market between 388 and 392 on the SPY. This shows me that there's still a lot of fear in the market. Again, rightfully so. And max pain has now moved for the options expiration here on Wednesday to 393. So if we go back to the SPY, or the SPX, that would basically put us at 10 points above where we closed here and very similar to where we are currently at the time of this recording. So again, kind of holding that idea of potential bullish move versus bearish because of options expiration. If we go to the Friday, at this stage, 390 is the big one. Again, quite a lot of puts sitting around 390, 385. Not a huge amount, but certainly there. If these start to spike up and we see huge amounts of puts entered in the next 24 hours, there's no reason why the market couldn't go rallying with the current price action that we're seeing, and then, of course, potentially fall maybe in August at some point. This is the problem. There's so many people that are bearish, and you can kind of see it manifesting in the options at this stage. Bitcoin, how do we look at this? Not that positively. It did get a little switch here in the last 24 hours. I'm looking for this level to be breached and broken above. That's around that 22,300. If that occurs, what do we get? Really a nice kind of potential pullback into what we would call like an inverse head and shoulders. Calling this zone is going to be tough. You've got a 61.8 fib of the whole move up at this stage. So it's that golden fib ratio. It does seem to have based, if the market continues to run, that is the Nasdaq, the smaller caps, so should Bitcoin. So Bitcoin should come up with it, and that would be fantastic. So nice level there. Potential here for Bitcoin traders certainly looks stronger. I'd like to see a new high broken and then potential movement up to this level that we'd like to see broken for the longer move towards the bull side. Very, very sketchy on crypto at the moment, and that's because sentiment is switching like this very, very quickly. If you haven't already, come and follow us over at FX Evolution on Twitter. Of course, join our Discord community, the public one. We have 10,000 plus of you out there, which is awesome, sharing ideas and concepts and economics and memes and all that type of stuff. And if you're ever interested, you can also join our private trading community on a free 7-day trial, which you can look at in the links in the description below. Do remember the data and the news that's coming out. So we have so much news coming out. The big ones here, Wednesday, FOMC statement, funds rate, and press conference. Expectation is 2.5%, as you can see here, 75 basis point hike. You'll notice how massive this hike is going to be. It's going to put us at the highest rate we've probably been at since for a very long time in the US. And then that happens at 2 p.m. New York time. Then we scroll down, we get the advanced GDP numbers out of the US on Thursday. And then after that, we still have more news other than just the earnings. Core PCE price index coming out 8:30 a.m. New York time again. So this week is jammed with news. If you prefer to sit back and just, make sure that you have, let's say, risk management, there's nothing wrong with that, guys. Remember, not every day is a great day to trade. The aim for every one of you out there is always to find the highest statistical chances to make money, and then of course to implement a plan. And that's what it's all about. Thanks so much for watching. If you enjoyed today's video, subscribe, smash the like button, guys. We'll see you in the next one. Bye for now.